Welcome to Front Range Facts. This is Anthony Meisner.
And this is Jim Merrion.
Let's get right after it. We have a big update for you today.
Yeah, we want to first talk to you a little bit about the National Association of Realtors, Chief Economist, Lawrence Yoon, talk a little bit about home sales, essentially getting back to what we would call a normal market. So 2019 levels is where we're kind of heading after a couple of years of just out of the park kind of sales. So today we're going to be talking a little bit about where things are headed. There's a lot of Chicken Little, skies falling headlines out there, and we want to just add a little what we think is sanity to the news and talk a little bit dissecting some of this information, really show that things are starting to get back to more of a level market overall.
Yeah, we have some good theses for you here today. And one of the big theses and the first takeaway that we want to talk about was all this sky is falling, market is slowing talk is really just getting out of that COVID market, right? I mean, you can see it here that we're still above the levels we were in 2017, 2018.
Yeah.
So I think that's a huge, important part of the puzzle.
So the sky, according to the media, is falling, but it's actually falling back into place.
Right back where it belongs.
It went to outer space for a while, and it's coming back down.
Yeah. So that's a really good sign. I mean, you can see it in the national data from the market here. This is total number of home sales for that part of the year, right? So really good sign, kind of where you can see it kind of trending down is really getting us sort of back into a normal stratosphere. We're not quite there yet.
Yeah, and there has been a pickup in inventory that's making all the news. You don't have to be a realtor to know that, but it's not from a increase essentially in new listings, but it's a slowdown in the pace of sales. Because the month supply of inventory is measured relative to the pace of sales. So you could have the same inventory but fewer sales, and then you have more months of supply. And that's essentially what we're seeing. It's just a little bit of slowdown because of the fact that the interest rates have gone higher. It's freaked people out, just like in 2019. For those of you that have long memories, a few years back, we went up to about 5% interest rates for a while. And what that did is it essentially hit everyone's business, 60 to 90-day time frame where buyers essentially retreated, and then they kind of got used to that new level, and then they were back to normal and that. So we're just proceeding with that a little bit.
So here's an interesting slide. I really like this one because it shows just how much some of this is transitioning by market, right? And obviously we live in Colorado, we're in the West, and the West is really starting to see inventory rises. Well, I mean, I'm sure all of you know this, but the inventory rises are because this is where there was no inventory, right? So seeing a huge percentage swings is kind of indicative of the fact that we didn't have much to begin with. So don't stress about the inventory rises by percentages. I mean, I think we've been seeing this a lot lately where some markets, you see these huge media numbers, right? 30% more inventory in Colorado. Well, when we came from rock bottom, like literally not enough for our buyers, this has really changed quite a bit of our pace. So I think you're going to see it in Washington. We're going to see it a lot in the Pacific Northwest. We're seeing it through Utah and Arizona and Nevada as well. But large swings in inventory in percentage numbers doesn't necessarily mean there's a lot more homes on the market.
No, we're still in a really low inventory environment, and it's just simply because a lot of people are freaking out about the interest rates and they're pulling back their buying activity.
Okay, so this one really spells it out for us, right, Jim?
Yeah.
I mean, we're basically nationally at 2.6 months of inventory. A buyer's market would be not until over 6 months of inventory. So that balanced market being that 4 to 6 months of inventory range, we haven't been in that since the peak of the COVID shutdown and that pure panic that we kind of all went through during that time. Yeah. And then in 2019, we saw a little bit.
Let's draw their attention to that one that's at 4.6, Anthony.
That's right here.
Right there. So that is COVID. Essentially, that's when people withdrew and freaked out a little bit, and the inventory levels went back up. However, if you look preceding that, they were never at 2.6 months of inventory. So
about that November, December timeframe back in 2019.
And remember, a balanced market is 4 to 6 months of inventory. We had to go back to like 2018 or so to see that kind of number. Or 2019, sorry, to see that number. So we are really just kind of still at a very low inventory environment with just people that are panicking right now and not wanting to buy because of higher interest rates. It's a slowdown for sure.
Okay, so what about this?
Yeah, year-over-year inventory levels, you can see that every month of the last 12 months, what I think is really interesting about this is that inventory levels have been down every month. And when we started this year, all the media was talking about how there's no inventory and home prices are going up crazy because there's nothing to sell. And everybody in the profession that pays attention to the data, was all predicting we'd have less sales this year anyways. And it wasn't a function of the economy or interest rates, but rather a function of the fact that there wasn't anything on the market to sell, thus we'd be seeing less sales. And we clearly saw that trend, when the year began with a 17.9% reduction year over year in inventory levels. And we're continuing to see that even now. And so that's a big part of the reason why sales are down for the year, is because the first half of the year essentially started out in such a rock bottom state.
All right, so decelerating home prices does not mean depreciating.
Let's just repeat that, Anthony, to everybody. Decelerating home prices do not mean depreciating home prices. And you are going to see why in a little bit.
All right, so let's talk about recessions. This is the fun stuff, right?
Mm-hmm.
All of you guys with the sky is falling data in the media, we want to rebuttal, well, everything. Yes, we may be heading into recession because the Fed is cooling off the economy, right? We can't have that 9% inflation that we've been dealing with. That's not great. So here we are with the last recessions, right? In 1980, you saw home prices actually went up 6%.
And interest rates in that 1980, 1981 time period, quite a bit higher, guys. Quite a bit higher.
We're going to see on another slide here, but like 13%.
Yeah. So remember, 2008 was a self-inflicted wound by the housing industry against itself, because we had a lot of guilt and we were just upset with ourselves, so we decided to hurt ourselves. But the fact is that normally in a recession, it's not caused by housing, and housing is highly resilient from a home price perspective to the ups and downs of a recession. So that's why you typically don't see home prices go down, rather they go up during a recession.
All right. And then here's some estimates and some forecasts for home evaluations kind of going forward.
2022 show.
There it is.
All right. There
I'm standing in front of it. So that's this year, 9%. Actually, that looks pretty good, right? That's kind of where we are. We're starting to see it slow.
Pace like 20 again in the first part of the year. So 9.3. Yeah, I think it's
the Fed's doing its job, right? Yeah. That's great. We're slowing things down a little bit. But going forward nationally, you have to keep in mind, Colorado generally outpaces the national market pretty consistently. So that 5-6% range, 5.5-6% range is what we see in Colorado. That is basically where, if the national average is around 4%, what we're going to see in Colorado.
Yeah, from 1990 to 2015, we averaged about 5.6% gain in Colorado annually. And so it's probably very, typical to see that then happen again.
And honestly, I think a lot of this is largely due to, does the Fed hit their target? That's really what we're looking for. But either way, if they miss their target by a little bit, it might delay things by a quarter or two. Right? They're really good about getting this right now. They've really been kind of dialing it in over the course of the last decade or so. So I have a little bit more confidence in the Fed than we've had in the past.
They were a little late in raising rates, Anthony.
That's true.
Well, experts don't believe the market is in a bubble or a crash at all, like it was during the Great Recession. The nation is still suffering from a housing shortage, which Anthony and I are going to be touching on quite a bit here. And it has reached crisis proportions at a time when many millennials in the beginnings of Gen Z are now reaching the age to start considering homeownership. And that is going to be probably the biggest wind in the sail to keep prices high.
It is. And here is our real concern. So Jim and I called the COVID years perfectly, I would say.
I don't like to brag, but we nailed it.
And here's why we're very confident in the real estate markets today. See, if you look at this graph from about 2008 to current, we didn't build enough houses, right? National builders have been too nearsighted. They have a long build cycle, but yet they still don't like to get lots into development nearly fast enough. Well, you have this huge void, right? I mean, look at the void. The average annual completed units is what we need. We need to be at that line or better, and we need to backfill basically a decade worth of underbuilding.
You guys see that in 1980, that little hole right there where it went below average, and in 1991 where it went below average, those were recessions. This is when home builders, because a lot of them are publicly stock-driven companies, freaked out because they were told to freak out because that's what their stock price is based on quarterly returns. But if they were looking at this as a 5-year picture, they would not be withdrawing. They'd be getting to conditioning more land to build more, because what the gray area on this shows is essentially what many economists estimate is, depending on which economist, but it's between a 4.5 to 6 million home deficit that this country has because of 2008 that we have never been able to address. We'd have to build, if we built 1.5 million homes a year, it would take 13 years to get out of that deficit. And we hit 1.5 million in the last 12 months. But guess what? All the home builders are retrenching again. So our thesis here is that, yes, it's a good time to buy right now. Yes, it's a little bit tougher to sell your home right now. Yes, there's less home appreciation. But in another year or so, we're going to be right back to the affordability crisis that we were. And I'll show it again a little bit why. It's because Gen Z and Gen Y right now, mainly the millennials, but starting to be that older Gen Z, are in their peak home buying years. And look at how many there are compared to the other generations out there.
Right. That 25 to 29 bracket is the largest group ever in the history of this country to enter home buying, which is why we're so underbuilt. And now they're running into this huge affordability crisis because there's nothing for them to purchase.
5 million home deficit. Yeah. You have the biggest population ever. It is going to be a long-term affordability crisis with this country. We're going to go back to seeing very difficult markets for buyers in the long term.
Especially in places like Colorado, right? I mean, there's certain places where people are leaving, and millennials and Gen Zs are actually notorious for leaving the Midwest, going to these city centers. So the city centers are incredibly underbuilt. Denver and the Front Range being one of them.
So we should start to see less competition and fewer bidding wars and less upward price pressure. And a simple analysis, this is kind of an interesting thing, especially if you're in the business as a professional here. A simple analysis, this is according to First American, chief economist. And he's with land title, but we take all people here. So First American's okay. In fact, a simple analysis shows that a 1 month increase in the month supply results in a 3% decline in annual house price growth. So let's say that home prices were to go up, say 10% in a year. Well, if there's a 1 month increase in supply, then it's 3% off of that 10% increase. It's not 10% changes to 7%, it's just 3% off of that 10% increase. So it's a moderate, minor amount of reduction in home price growth. And that's why you're going to continue to see home prices grow over the next few years, according to economists. So this original forecast was that we were barely going to see any inventory increase. There was going to be a slight uptick this year.
Original, right here, above my head.
But now they've updated it because home price sales have slowed. Again, it's not a huge growth of homes coming onto the market. There isn't a distressed wave of sales that are occurring here that are just flooding the market like it was in 2008, where suddenly people had no jobs and couldn't afford to pay their payments.
Quite the opposite, right?
Quite the opposite. Yeah. So what we're just seeing is it's taking longer to sell, and thus the forecast for inventory has gone up 15%, which is very moderate.
It is.
And throughout history during a recessionary period, interest rates go up just like it has at the beginning of a recession. So we saw that happen starting essentially in around May, or a little bit earlier in April. But in order to come out of a recession, interest rates are lowered to stimulate the economy moving forward. So historically, we have seen a repeated uptick in interest rates followed by then lowered interest rates. So sometime towards the end of next year or so, we'll see those interest rates going down, if not sooner. And, that's what's the typical cycle. So expect that to happen. And if you need to refi then a year from now, then so be it. You've gotten a home for a little bit cheaper price than your peers.
Absolutely. So let's talk about the recessions here. So these are all the recessions in the past since 1980 current. And as interest rates are rising to pull down that inflation, we are going to see interest rates rise, which will push us into a recession, right? Mm-hmm. Which is well needed at this point because 9% inflation is not okay. And we can't get back into the hyperinflation like we saw in the 80s, right? So that's where we saw those interest rates have to get up to 16, 18% to pull us out of those recessions. But what happens during a recession? We need to heat that economy back up. And by doing so, mortgage rates have to drop in order to flood the market with some more money. So you guys saw what happened in COVID. We all have at least short enough, time frame in our memory to remember that. So in 2020, what happens? We pump a bunch of money in the market, we shut things down. And in order to get things going again, the Fed dropped rates down to zero, bond markets hit all-time lows, and we were at 2.8% interest rates on our fixed home loans, right? So that flooded home buyers into the marketplace. And keep in mind, real estate being one of the major pedestals of the economy, right? One of the main pillars of the economy is going to drive us back out of that recession. So we see it every single recession, right? Lots and lots of green arrows because interest rates will come down.
They are going to in about a year or so.
Yep. Okay, so here are the 30-year fixed rates and a projection from Freddie Mac. So what they're expecting is we're expected to kind of peak out about now. Well, maybe a little bit of an uptick from here, but I mean, they're basically talking about 30-year fixed rates somewhere in the fives all year next year.
Yeah, we're in that Q3 uptick essentially right now is where we're seeing it, and rates the Treasury basis went up 75 basis points this week. which does not mean interest rates for loans go up that rate, but they do tend to correlate. So we anticipate some additional ups and down swings with the general curve towards the up swing through most of 2023. And by the end of 2023, we'll be essentially coming back down in interest rates because it needs to address then that economic swing.
Oh, absolutely. All right, so here's showing activity. Jim, you pulled this from Showing Time.
Yeah.
What are we seeing here, and why is the West 45% less showing?
So we say it every time, Anthony, but showing activity precedes sales by about 90 days. That's kind of the rule of thumb we use. So Mike Lane, Vice President and General Manager, Showing Time. Hey, Mike. Showing activity continues to be at lower levels than we're used to seeing at this time of year, pointing to a market in transition. Following the surge in mortgage rates, it's reasonable to expect that showing activity will continue to ease, especially when compared to last year's historic numbers. So everybody right now is slowing down their showing activity because of the higher interest rates. So less buyers right now are feeling comfortable with buying because they're seeing all this doom and gloom on the news, and because they may be in fear of their job. There are layoffs that occur in 7-Eleven, just laid off a bunch of people this week. Dell's in the process of doing so, and there's other large companies that are scaling back. So we're going to see a reduction in just buyer demand because of potential job loss, entering recession for income issues, and the affordability with higher interest rates. But what this doesn't really indicate is the fact that we were already down in showing activity all throughout the year because we were at rock bottom inventory levels. In fact, probably the lowest inventory we'll ever see in our lifetimes is where we started this year at. It was just almost not even a month of inventory available to sell. So we were seeing all year long, before interest rates went up, a lack of showing activity because there wasn't enough homes for people to see. And a lot of times, we'd have like a 2 or 3 day window to see homes. If you booked up solid, you could even get into homes if you wanted to. So now we've got a big swing in the other way, where we're just seeing also then the aggregate of more buyers that are pulling away from the market. So that's why.
All right, so that wraps up our national portion. Who are we? I'm Anthony with Land Title. Thank you for joining us on our first portion. We're going to get into Colorado and the local markets here in just a minute. If you want to reach out to me, have any questions, 303-968-9868 or ameisner@ltgc.com.
And I'm Jim Merrion, realtor here at Coldwell Banker. I can be reached at 303-548-0243, or you can always email me at jim@ourcoloradohomes.com. And, don't forget to check out our podcast we do occasionally on real estate and the cryptocurrency and blockchain market, which is Get Real with Blockchain as well.
If you want to reach us here on the show, frontrangefacts@gmail.com. Anytime, we'll give you our deck and use all this fun information for your own purposes. All right, so let's talk about Colorado a little bit. Let's talk about Boulder versus the nation. Since we're in Boulder, we found this real fun stuff from Apartment List.
We don't talk about rentals too often because we tend to sell homes here in the title and real estate business. But there's some interesting trends, I think, which add into the large picture.
And I really think this is one of those things why we like to remind people how important it is to purchase a house, right? Because when rentals are going up, these extreme swings, or the median 2-bedroom rent in Boulder is $2,000 a month. You can buy a lot for $2,000 a month, right? That's kind of how people perceive what they're purchasing is mostly on monthly payment. So that's why we wanted to talk about this. We've only got a couple of slides on rental data, but here's kind of where we're stacking up. You can see the yellow line here is actually the percentage change from last year to this year. So the Boulder markets are really not swinging fast, but you can see a lot of the other stuff, or the other places in the country, are having huge rental increases. So what does that mean for us in Colorado? Well, it's just Boulder, right? You can really see here, Westminster saw a huge increase. Places like Arvada and Aurora and Longmont, even into Fort Collins or Colorado Springs, are seeing 10+% increased changes on their rents. So it's getting very, very expensive to rent, and we're really predicting that that's going to continue. So check this out. This is what I saw that I thought was really fascinating. On a national level, we have 14% increases in rent growth over the last year. We had 12% in Colorado, 12.5%. Boulder is more like that rubber band, right? It's, already a little bit more expensive marketplace. It gets really high and then it comes back, and it gets really high and it comes back. And you see this over time, and here we are again in this point in time where we really expect rental rates to rise rapidly again, because they're not in line with the nation. They're definitely not in line with Colorado. And when places like Westminster have a higher rental rate than Boulder, right? So it's going to get very much more expensive in Boulder again, but even in Colorado, it always trends pretty similar.
Great time to be a renter in Boulder right now, and long-term expect your rates to go up suddenly and rapidly.
Yeah, and I think it's just a really good reason why at 14% increases in rental rates. Housing prices are expected to only go up 4% next year. This is an awesome time to get out of those rentals, get into purchases if you can, right? Even though it might seem a little scary.
Let's look at this though, Anthony. I mean, you raised a really good point with this one. This is the showing time data, and this graph, tracks essentially the last few years from 2020, 2021, and 2022, the weekly average. And that yellow line is the 2022. So it looks like it's flatlined now, Anthony. You want to talk a little bit about that?
Yeah, so I think what a lot happened here is as rates started to rise, that was early on in this March timeframe here. So we could see right down in here how rates had been not really a question, right? We were short on inventory, but we were still seeing a lot of showings. And then in that early or beginning of March timeframe, we started to see the upticks, right? So during those upticks, we started pulling buyers out of the market, right? Every time people got to afford a little bit less, right? And then you get all the way down into the May timeframe, the June timeframe, and we really hit the bottom of where the market was going to be. We usually see a summer slowdown in showings. Yeah. You see it every year.
Every year.
It happened last year. It happened in 2022. Yeah. That dip right there is the 4th of July, right? And so, but you can see that it's flatlined right now. Yeah. So we're starting to see an increase in buyer behavior, getting used to these new rates, right? People got scared at first, but we don't normally see showings stay steady right now.
Yeah, so every year it goes down.
I mean, basically after 4th of July, we have a flat line. Yeah. This is a really, really good sign that buyers are getting accustomed to the new rates. They're not scared off by it. And in Colorado, we just have a huge abundance of new jobs, right? People are needed in this economy far more than a lot of other places because of all the incoming jobs and those Gen Zers and millennials specifically.
Well, here you can just see even when, the market was still on fire because we had nothing for sale, we had less showing. So, we clearly all year were missing the mark from previous years because of that inventory issue. So that's a compound effect, essentially. That's correct.
Yeah, essentially. So earlier on in the year, we were off by about 40% from the previous year. You can see that showings were actually higher in January than they were in the peak of the market here because there wasn't anything to show. So now that there's a rise in inventory and we've seen those buyers kind of reset their footing, we're kind of getting into this new normal. So I think this is a really good sign for the market right now that we've actually had a pretty strong July for showings because, like we always say, 60 to 90 days from now, that's what you're going to be seeing in our sold data. All right, so let's get into the state of Colorado specifically. There's a few major takeaways here. New listings coming to market are really not up that much. They're only up 2%.
Yeah. So to remember what we were saying was that, this increase in inventory is more of an effect of a slowdown in purchasing rather than a flood of new inventory. You can see that with only a 2.4% rise in single-family home inventory.
Yeah, so that's a big takeaway. The other takeaway that is this little 90-day hiccup that we're experiencing, you can see the pendings and under contracts are down 21%. Well, they've been down about 10% for the year. So we're in the middle of that, like where buyers are kind of figuring it out again. The other thing is the Fed has really started to actually work where price appreciation is not 20+% like it was at the beginning of the year. We're starting to see that average down to about 7%. That's a good sign. Well, when we go to the next slide, this is our next slide here on the townhouse condo market, that attached market, the inventory shortage is still a very real thing in Colorado. So that townhouse condo market is appreciating faster. We're going to see this also start to trend down, right? We're not going to see 19% appreciation all year, but from last year to this year, we had such a bad inventory shortage, it's going to take a little bit longer for it to catch up. But you can see it. New listings are down in condo townhouse, right? I mean, that is concerning compared to the up that we've been seeing in the.
Look at the growth in price, year over year. You've got, the average sale price went from $484 in June of last year to $578 in June of this year. So,
yeah, good time.
As I said to Anthony, you can't expect to get drunk and not have a hangover.
Exactly. So let's get a little bit closer into this. I wanted to show what's actually happening with new listings. New listings are homes coming to market, right? It's not sold, it's none of that. But see how consistent this is over time. I mean, this is really what I want to articulate and reiterate to everyone is new homes come to market because people move for specific reasons, right? Marriage, divorce, have a kid, whatever. You need a bigger place, you need a smaller place, your job moves, right? So there's only a specific reason that people buy and sell real estate. That doesn't really change over time. You can see in 2020, it got reduced a little bit, and that created some of that inventory shortage. You can see that the sales over time from basically 2013, 2014, have been soaring compared to previous years.
Mhm.
And it really hasn't changed much, right? So we have lots of new inventory coming on and off of the market. It's peaks and valleys with new listings. But those numbers in the townhouse condo markets, they kind of follow and trend in place. The pendings follow the inventory in many ways. So as we were talking, that shortage of inventory has created a shortage in under contracts. It's restricted the market, which creates that, price appreciation that you saw in that attached market or the detached market anyway. We're at 11%. That's huge. These are great numbers. So, no rest for the wicked in the real estate market there. The last one that I think needs a lot of explaining, percentage close price to list price. So that percentage, this is basically saying that at 102% listed sale price, we're still in bidding wars all the time, at least what closed in June. But this is, this is 60
60 days, before, these prices went up. I mean, we are in the summer slowdown, B, the market freak out of rates, and C, this onslaught of a recession that's, probably looming over our heads. So of course we're going to see it slow down the activity. So it's a trifecta essentially that's approaching the summer markets. It's hard to separate the noise between each of those three. What is the contributing factor that each one of those brings to the table when all three happen at the same time?
Well, and all three are going to happen at the same time, and that's okay. So if we understand all three are going to happen, we expect to get back to somewhere like 2008 time period, right? Where we have, in the good part of the year, we're around 100%, 101%. And, in the rest of the year, where we say it's the fall.
2018. You said 2008.
2018. 2018. And then in the fall, we still approach that, 98% time. I would expect us to see a very similar pattern into next year where we saw that 2015 to 2018 period where that was a very healthy real estate market, right? So we're kind of getting back out of the clouds, getting back into reality where, we all actually have to work a little bit harder and do our jobs to make sure that those homes are selling, they're priced appropriately, and, we're working through it. But if you're buying, this is an awesome time to buy homes still. I don't think there's any gloom and doom here.
Let's shamelessly self-promote ourselves again, Anthony.
I'm Anthony with Land Title. You can always reach me on my cell when you have questions at 303-968-9868 or at ameisner@ltgc.com.
And Jim Merrion here, Realtor, 303-548-0243 on my cell, and Jim at ourcoloradohomes.com on my email.
Perfect. Let's get into Denver Metro. Today we're actually going to skip most of the Front Range because everything's acting really similar, and we wanted to keep it nice and short for you. But in Denver Metro, you're seeing that rise in inventory happen quite a bit faster than the state as a whole.
Absolutely.
We're basically down 18% in under contracts right now. The active inventory is up 50% in active units, but 50% from basically under 4,000 units to 6,000 units. We're nowhere near balance. Balance in the Denver Metro market is like 15,000 units.
It is. It's in fact,
20,000.
And what I want to reiterate what you've talked about occasionally on our podcast over the years is that when the market peaked in the 2008 recession, we were at 28,233 listings. Okay, so that's a huge difference from where we're at now. So this idea that, the sky's falling or prices are going to drop dramatically and you're going to get some sort of steal if you wait 6 or months, get your head out of the clouds. It's not going to happen.
Exactly. And what you can really see here is you can see that the market locally has started to slow down a couple months earlier than it normally would have. So normally we would see the market peak in June or so. We really saw a peak in May this year. So that largely is due to interest rates and kind of that, turning the buyers down, right? Not as many buyers in the marketplace. The listings haven't changed, like I just showed. We're really consistent with new listings. New listings come on and off the market like they always do, regardless of what's going on. So this is all driven by buyer behavior. Now, if we look into the next slide, the biggest thesis that Jim and I want to talk about is how Colorado does not act like the national market in many ways. Look how much shorter the inventory is here. 1.1 months of inventory is all we have in Denver Metro right now. Yes. Is that a huge change?
Those are June numbers. So this is not some sort of way back in March thing. This is last month, 1.16 months of inventory for detached and attached homes.
So when we see 50% increase in inventory or 50% increase month over month in active inventory in the market,
dramatically less than the national market.
We went from 3 weeks to 4 weeks of inventory. So that's where I think we really need to kind of take it apart a little bit and understand what's happening. we had 1 week of inventory in June and or January and February, and it just wasn't enough, right? I mean, it's not enough to get anything done. It's chaos. No one wants to be in that market. We saw that kind of last spring. We're nowhere near balance, right? We need to be at 4 months of inventory to be in a balanced market. So from a supply line, we have a long, long ways to go, and I really just don't think we're going to get there anytime in the next couple of years. The other part of the situation is, what are buyers doing? They're putting homes under contract at lightning speed, right? Remember when it was COVID 2020, everyone's locked at home, everyone realized, like, I hate my house, I don't want to live here, I need more space, I need a second office. Well, that was 23 to 26 days on market on any given time. That's over double what we have today. We still have the fastest real estate markets, even faster than it was last year. So buyers are putting things under contract very, very rapidly. Lenders have given them the ability to do a lot more and close even faster than before. And so keep in mind that the buyers out there are very, very serious. If you're a buyer, you should be serious, and you should have expectations to go out and shop early and often when you see homes.
Because there are just less buyers, again, because of either fear of recession, fear of job loss, or they don't like the fact interest rates have gone up. Well, if you're a seller, price, in line with the comps, be a little more aggressive with your pricing, and make sure you fix up everything you can, because there is a bit more of, competition among sellers right now, but it's still traditionally way less than it has been historically. And from a national perspective, we're way better than the national.
Yeah, and I think the big thing locally is the submarkets are all going to shift to different rates. You can see Arapahoe County's at 7.5 days in the MLS, where you have places like Delaware County at 20 days in the MLS. And they're all going to start changing at different paces, but they're all going to trend in the same direction, right? So we can kind of talk macro in order to understand the market, but you really need to dive into those submarkets if you're going to buy or sell in a local area. Jim, you really wanted to talk about this slide.
Yeah, it just, I want to draw everyone's attention to the fact that gray was last year's sold units and red is this year's. And since we're starting obviously in January at the beginning of each year, we haven't had a month this year except for May where sales exceeded last year. And so, the idea that, you see all these headlines that say, oh, sales are down, real estate sales are down so much year over year. Well, guess what? We were like this all year, even before interest rates, even before the war in Ukraine, even before, the recession hit, because we had nothing to sell, and we continue to have very little that's available to sell. And, so the fact is that we've got some headwinds now, which have caused that June drop to be a little bit more than you've seen in those other months. But we're looking at a very healthy market overall if you're trying to sell. And you're still looking at a difficult market if you're trying to be a buyer. The prices are still high, and they're going to continue to be high.
Absolutely. And this really kind of plays into that. That percentage sold price to list price locally is a whole percentage point above the state of Colorado here in the metro area. And if you get into the Boulder market, it's even higher than this. Essentially, there are plenty of bidding wars still taking place. Those buttoned-up houses that are like that, that's what's happening. Now, this is 60 days ago under contract data. So it's coming back to reality. We get into that 2015 to 2018 timeframe again. Expect it to go back to some sort of normal market. Back in, we're going to peak just over 100. We're going to valley in, the fall winter season to that 98% range or so. But it's just resetting that expectation, right? So as a seller, you're not going to get the major bidding wars anymore, I think. As a buyer, that's a good sign. Maybe we can actually get in and find something. It's not going to be a bargain, though, right? The sky's going to fall.
Our closing thesis essentially is that we're in a typical summer slowdown that's compounded by a couple of factors. We're going to see that market normalization start to return after Labor Day weekend, and we're going to see that continue as an upswing in sales through Thanksgiving, with a slowdown then seasonally until about the second week of January. And we'll see some market normalization around the idea of higher interest rates next year at the beginning of January, with a lot of people looking at either 7-year ARM type of arrangements, or the lenders have gotten really creative with these 2-1 buy downs, where they buy down the rate for 2 points the first year, then 1 point the next year, to get you then to the point where the Fed starts to lower interest rates again to counter swing the economy in the other direction. In another 18 months or so, a year from now. So the rates will be down, people will be refinancing again in a couple of years, and it's all good, guys.
Hang in there. It's a bumpy roller coaster right now, but it is sure entertaining to watch. and we love looking at the data. So hang in there with us and catch us on the next episode of Front Range Facts. I'm Anthony Meisner with land title 303-968-9868 if you want to get a hold of me, or ameisner@ltgc.com.
Or more importantly, you can call me. I'm Jim Merrion, realtor at Coldwell Banker at 303-548-0243 or Jim at rcoverhomes.com. Thanks, guys.
Don't forget, you can always catch us on Get Real with Blockchain for all of your real estate and blockchain needs. You can get that anywhere you get your podcasts, or reach out to us here on the show at frontrangefacts@gmail.com. See you next time.